Thank you for joining us and welcome to Business Incorporated. I'm Chimeze Obi Iwago. On the show today, markets brace for global recession as coronavirus spreads in 3 continents. South Africa's credit growth in January slows to 5.01% year-on-year. And Zimbabwe State Power Company to increase electricity tariff by 19.02%. And investors dumped equities in expectation of a global recession and the world prepared for a pandemic of the coronavirus as countries on 3 continents reported their first cases on Friday. Share prices were on track for the worst week since the global financial crisis in 2008 as virus-related disruptions to international travel and supply chains fueled fears of recession in the United States and the Eurozone. Ratings agency Moody's says a pandemic will trigger global and U.S. recessions in the first half of the year. And markets in Africa were not left out in the sell-offs due to the spread of the coronavirus on Friday. South Africa's JSE continued with a sea of red on global markets as the index shared 3.30% at intraday. In Nigeria, the NSE shared 1.74% as the country confirmed its first case of the coronavirus. Egypt closed for the week negative on Thursday by 1.45%, while Kenya closed negative on Thursday. And stock markets in the Middle East closed for the week lower on Thursday as a jump in coronavirus cases outside China triggered fears of a pandemic. Saudi Arabia's benchmark index dropped 1.07% as RG Bank fell 1.4% and hotel operator and developer Jabal Omar Development sank 6.6%. In Qatar, the index fell for a 5th day to close 0.61% lower, with commercial banks shedding 3.3%. In the UAE, Dubai's main share index declined 1.17%, hitting its lowest level since May 2019. Only the Abu Dhabi index ended 0.22% up, buoyed by a 1.3% gain in the United Arab Emirates' largest lender, First Abu Dhabi Bank. And in Europe, stocks extended a historic week of losses on Friday morning as the coronavirus outbreak continues to pummel global markets into correction territory. The pan-European Stoxx 600 fell 3% in early trade. Travel and leisure stocks dropped 3.5% to lead losses as all sectors and major bourses slid sharply into the red. Let's bring in Chelsea Dulane, my colleague there at the Frankfurt Stock Exchange, to tell us more. Hello, Chelsea. Good afternoon. Well, global stocks were on track for their worst week since the financial crisis as concerns about coronavirus mount. What are investors saying about how much further markets could fall?
Investors think this could really just be the beginning of a longer downturn for stocks. Here in Frankfurt, the DAX was down over 5% earlier in the session. It's traded up a little bit since then, but it's still on track to decline more than 10% this week. Investors are really grappling with a mountain of uncertainty right now. Every hour, every few minutes, there's a new headline indicating more disruptions from the spread of coronavirus, more cases here in Europe, cancellations of big events like the Geneva Auto Show. And investors are really struggling to sort of forecast what the economic impact of this could be. But companies are already struggling with disruptions in China, with business shutdowns there, with quarantines that led people to stop shopping, and supply chain disruptions. And now they're facing that same risk on their home front. And this could really lead to global recession, as you've mentioned, and that's really a scary prospect for a lot of investors. And if that does happen, this could, yes, become much bigger sell-off. One forecast I've seen from RBC Capital Markets forecast stocks could fall as much as 30% from recent highs if this does turn into a global recession.
Now, investors are counting on central banks to step in and support economies. What have officials at the European Central Bank there in Frankfurt, what have they said so far?
The ECB officials have been quite mum on this so far. They haven't signaled a lot of concern about the economic impact of the coronavirus, even though country governments, Italy, Germany, are warning that this will dent their growth for the year, and they're already so close to recession, this could really tip a lot of countries over the edge. What we have heard from Christine Lagarde, the head of the ECB, is that they're watching the situation quite closely, but they don't think at this point the coronavirus poses a long-term threat to inflation or consumer demand or supply at this point. But I think investors are a little bit flummoxed by that stance. They want to see more action, and they want to see quicker action on the part of central banks, because clearly this is already having a big impact on market confidence and on consumer confidence.
Of course, talking about corporates there, Germany's ThyssenKrupp is selling its elevators business to a group of buyout firms for 17 billion euros. Could more division sales lie ahead for the struggling conglomerate?
It's definitely on the table. ThyssenKrupp has been under a lot of pressure over the past several years, in part because it's been facing falling profits. It's taken on a lot of debt, so it's having financial issues, but it's also sort of struggling in this new world where people don't really like conglomerates anymore, where investors are really skeptical of the conglomerate model. So a company like ThyssenKrupp that makes a whole range of different products, they make submarines, they make steel, auto parts, elevators, and until now, investors are quite skeptical of that model. So this is really the first step for them, selling the elevator business. But they have said, and they said today, that they are going to be looking at all of their business units. They're going to leave no stone unturned, and they plan to come to the board in May with a report on what kind of businesses could be next. One area that investors have been focusing on is this business where they build plants, and that's been one area where people really think they might either attempt to sell or shut down that business coming forward. But I think there's definitely more restructuring and more reorganization ahead for this company.
All right, Chelsea, we'll continue to monitor the effect of this COVID-19 on the market. Thank you for your time and stay safe.